My name is Mark Lamonic. I'm the product manager for Morningstar Premium, morningstar.com.au, and today we're going to talk about lessons from great investors. But first, we have to go through our housekeeping items. So number one, everything you hear today is general advice. I can't offer you any personal advice because I don't know anything about you. If you're in New Zealand, you can go to morningstar.com.au to find our FAP, and you should seek out an advisor if you want any personal advice. The other thing is I would love questions. So there is a Q&A function. And a chat function. We have a comment, Shani, that here I was thinking Shani was doing the presentation. Shani's actually eating right now. So she has fried chicken bao buns. And pork belly.
It was the place with the smallest line.
Yes, she says it's the place with the smallest line, but she's pretty happy. And she got fries, but she was disappointed that they were sweet potato fries. But anyway, so Shani, people wish you were doing this. All right, so we're going to talk about lessons from great investors. So last night, I decided to make this a little bit different. I would try to find great investors that most people may not have heard of, because I figure we can't just go through the whole Buffett, Charlie Munger thing every single time. So I tried to find new people. So hopefully you like them. I think that some of these lessons are pretty good, but of course I would because I put it together. All right, we're going to start with this guy called Nick Sleep. All right, first a little bit about Nick Sleep. We have to do some, biographical information since people may not have heard them. So he started something called the Nomad Investment Partnership in the UK in 2001, and he ran this thing for 13 years. And in that 13-year period, he had a 20.8% annual return versus an index return of 6.5%. So, yeah, pretty good track record. And he had a very wide mandate. So basically what that means is he was able to invest pretty much anywhere he wanted. So a lot of times when you go into a fund, there's a narrow mandate, which are basically the rules that dictate what somebody can invest in. They can invest in large cap US stocks, for example. Well, he had the whole world. He had all different sectors. He had all different size of companies. Why are you laughing? Oh, okay. And he had a quote that he liked to, he talked about a Woody Allen quote to talk about why it's good to have a wide mandate. And that Woody Allen quote was basically saying, being bisexual doubles the chances of a date on Saturday night. So that's why a wide mandate is good, according to him. And I mean, frankly, at this point, any quotes involving sex and Woody Allen probably are not good things. But anyway, I said it anyway. So there are two big lessons that I think you can take away from Nick Sleep, and here are some of them. Sorry for the long quotes. They are a lot shorter when we go into this. But let's start with the first one. So information like food has a sell-by date. Can we raise the volume, Will? You saw that? Okay. So now I'm even louder, so everyone else can turn down their volume on the computer, so you don't have to hear me, don't have to hear me too loudly. Okay, so he talked a little bit about, and we'll get into this information like food has a sell-by date. So what he's confronting here, of course, is the fact that we are in information overload now. We have all this different data as investors. We're bombarded by it every single day. And one of the secrets, of course, is to figure out what is actually pertinent information and what should we ignore. And Nick seems to believe that we should ignore the vast majority of it. And he talked about David Attenborough, and he was interviewed once, and the host said to him, "You have seen more of the world than anybody else who has ever lived. You must be the greatest naturalist that ever lived, just because you have such a wide viewpoint of the world and what's going on." And he said back, "I am not. Charles Darwin only spent 4 years traveling and the rest of the time thinking, and that is why he is the world's greatest naturalist." And so Nick agrees with this, and he wrote about it in one of his investment letters. And the message here is pretty simple. Study something intensely, but then go away and think. And he talks about how the human mind just needlessly collects all of this data. And that what that does is it interferes with the ability to step back and have rational thought and actually process information. And that's what he's talking about here. And you can see in this sort of second paragraph of his quote that there are so many different distractions that we all face as investors. We're getting constant news. We think that we have to react to everything because that's what we're told we're supposed to do. All the media and everything else that we hear about business and investing in, everything else that we need to react to it, and he doesn't think so. So he thinks that what you need to do is step back and think about and study what makes a truly great business. And he said that really, at the end of the day, it's simple human attributes that lead to a business's success. So it's thinking about, why is a business actually successful? Why will it be successful long term? And this is thinking a lot about competitive advantages, and we'll hear a lot about that today. And so he has another quote. So he says, "You feel differently drinking a Coke than a no-brand cola." Think about that. Think about why that is, and what is the actual consumer benefit that all of these different companies are solving for people. And a lot of that is about feelings and the different stimuli that a brand, that the way that you feel when you're consuming a certain product, produce in people. And so first thing, step back, ignore the data, spend some time actually thinking, which I like, because I think we're all so busy and we have smartphones and everything else going in our life that's hard to actually spend any time thinking. And then I like his second one as well, the joy of doing nothing. And he's talking about patience here. And so often, and he was comparing himself obviously to other professional money managers, but as individual investors, we have the same advantage. So often people are caught up, and they're caught up because, particularly from a professional money manager, because of the industry, because of the fact that they have career risk, everything else that they're doing, we don't realize that patience is actually something that is a competitive advantage for us, or investing edge for us as individual investors, that we don't have this pressure. Any pressure we sort of put on ourselves. Maybe it's the pressure to try to keep up with our friends, try to keep up with what you read in the newspaper, but in reality, there really is no pressure if you have a long-term time frame that you can take patience. And in his view, he just talked about how Nomad, his investment partnership that he was running, they had a holding period of 5 years versus an industry average of less than 1 year. And just simply the fact that they had the ability to hold securities for longer, he thought they actually got rewarded for that, and that equity returns will increase over time. So he thinks short holding periods means there's really, really intense competition to try to predict and figure out where a stock price is going to go. But if he can take a step back and take a look at what is the longer term risk, not the risk that a share price might go down in a year, but what is the longer term risk to a company, because that's going to drive those long term returns, then it makes it a lot easier to be an investor. That you're not worried about, is the next inflation rating going to go up or down? You're not worried about, are interest rates going to be raised in a year or 5 years? You can take a step back and look at the business and ignore all of that market noise. So I thought that was really great. And he has a quote, which I also thought was good. He said, "In our opinion, business outcomes can be more predictable several years out than they are in the near term. For example, we have no idea where the market will end this year, but given corporate strategies, capital allocation, and starting valuations, I think we have some idea of how our companies will evolve over the next 5 years. In other words, the return from investing in shares can be both increased and de-risked over time." And he thinks time creates opportunities, and maybe that's something that we can all think about now, depending upon what our viewpoint of the market is. So time creates opportunities, and what you need to take advantage of that opportunity is dry powder. So at the end of the day, cash, take advantage of the inevitable opportunities that come. And while it may feel like over the next year, and this is something I've been thinking a lot about, whether it may feel like over the next year or the next 6 months you're falling behind as you hear your friends talk, as you see things in the newspaper, just realize that there will be an opportunity. The business cycle is not broken. Certainly the stock market cycle is not broken. At some point, there's going to be a lot of opportunity to go buy things cheaply. So what can you do to prepare for that? Well, keep some cash and also spend some time thinking about the long-term competitive advantage of different businesses, because that will enable you to actually pull the trigger when the market does pull back. All right, that's Nick Sleep. We've got a couple questions, so if they're related to this. Oh, someone else said they could barely hear me. What a blessing for you, but sorry. Hopefully Will turned it up. Will has lost, Will, you've lost your touch. You go away for one day and it's all over. And we didn't do this on Tuesday either. All right. Our next investor, and I use investor loosely with her because she was more of a businesswoman, but I think had some really good lessons for investors, is Kate Cole. So Kate Cole is a pretty amazing story, which we'll go into a little bit. But she was the chief operating officer and the president of Focus Brands. So Focus Brands owns a number of different things in the US. And she used to be the president of one of their subsidiaries called Cinnabon. So I don't think there's Cinnabon in Australia. Okay, so Cinnabon, basically in all the malls in the US, you go and you buy this cinnamon bun that has like 9,000 calories in it and like instantly kills you, but is really delicious and they smell really good. So like the whole mall smells like Cinnabon. So she took over as Cinnabon, and what I liked about some of the things and some of the business lessons that she put into her books is she talked a lot about goal setting. So something, if you've listened to these things before, is really important to us here at Morningstar. We are proponents of goals-based investing, very simply because if you don't know where you're trying to go, you're not going to figure out how to get there. So she's got two examples here and her couple different principles of risk. So you can obviously read, to go down the least risky path, you need to identify your goal. And this is what confronted her when she took over Cinnabon. So she took over in 2010, and Cinnabon, despite ballooning obesity in the US, had 6 years of net sales decline. And part of this obviously was it was coming out of the GFC, and because of the recession, people stayed out of all the places there were Cinnabons, malls, and airports. And there was also this idea that despite, as I said, the ballooning obesity, people wanted to eat healthier. And so these very indulgent Cinnabons, they were shying away from them. So her goal when she came in, what she was told by the parent company, is just increase sales. No other direction. You need to stop this sales decline and increase sales. And she started talking to everybody at the company and started realizing that they had lost focus of this goal. And basically they lost focus of this goal because they were spending all their time trying to figure out what is a low-calorie option for this extremely indulgent dessert. And Shawnee is like looked up at that. But yeah. What's a low calorie option? And she immediately sat there and started pointing out all the different issues wrong with their environment. So all these low calorie snacks that people were looking for were kind of high volume snacks, right? Things that you eat every day, but Cinnabons were a treat. So she automatically sat there and figured out, okay, us making a low-calorie option that does not taste as good and doesn't provide that same decadence that a Cinnabon does is not going to resonate with consumers. So all she did was made them smaller. So she didn't change anything about them, she just made them smaller. So now people, if they wanted to eat a bunch of them, they could order a bunch of them. They could also get less by making them smaller. The franchises weren't happy with this whole thing, but within a couple years, the revenue of Cinnabon doubled, and it became a billion-dollar brand. And everyone's sitting here thinking, I can't wait for the borders to open so I can go have a Cinnabon, right? Maybe just Shawnee. So that is the first thing. And where she came up with this was focusing on the actual goal. And once again, I think a little bit, it's like ignoring information that doesn't really matter and doesn't pertain to what you're trying to do. And we'll go into the second one, then we'll bring this back to investing a little bit. The other thing is, of course, as you said, all gambles don't pay off, but you increase your odds of more successful outcome if you can define and articulate your goal. And there's a good investing one here, but we should talk a little bit about her. So the amazing part about her story is her parents got divorced pretty early on. Her dad was an alcoholic, out of the family. She started working very, very early to start supporting the family. And she actually got a job at, I won't name the restaurant, but she got a job at a restaurant. And she was working there and started to do very well, to the point where they were actually asking her to go, it was a franchise restaurant, go and train other people at different franchises. So she starts going around and training other people at different franchises. And she was in uni at the time, going part-time, and she actually decided to drop out because they had offered her a pathway to get to the job that she wanted. And she thought, okay, well, uni, I was always using uni as a means to an end. I was using uni to get a better job, support my family, but now I'm actually being offered this path, and actually staying in uni, in this case, is not the safe option. So she dropped out, and before her Cinnamon role, became like an executive vice president of this large restaurant group. So what do we get from this as investors? It's thinking about your goals and thinking about the way to get there in the easiest way. And when we think about how we get there in investing, it's risk, right? Taking on more risk as an investor, risk as in volatility. So taking on more volatility is the way that you get more return, so you're actually compensated for this. So as investors, it's important to look back at risk-free. What is the risk-free result of being an investor? So this can do two different things for you. Number one, it can make sure that you're actually taking appropriate risk. So for people that decide, what is the risk-free? The risk-free is keeping your money in cash or government bonds. That is the risk-free approach to investing. But we can step back and see what that outcome is going to be. So we start there as investors. So if I have a certain amount of money now, I can save a certain amount of money. I earn the risk-free return over the long term. Where does that get me? Well, in most cases, it's not going to get you to your goal. But then we can start there and just layer on risk until we actually get to a point where we can achieve our goals. Now, why do most investors don't do this? Because they come from the opposite end of the spectrum. There are certainly people that are cautious, that don't want to go out there. But the other approach most people take is they think that they just want the most money possible, so they're not even thinking about a goal. All they're trying to do is get the most money possible, and all of a sudden they find themselves in all these very speculative investments. And they're invested in crypto and these crazy thematic ETFs and little mining stocks and WA and all of the things that are very, very risky, when they don't necessarily have to take on that much risk to get their goal, because their goal is not to have the most money possible. Their goal is to retire with a certain amount. Their goal is to buy a house, etc. So very, very important. Focus on the destination and where you're trying to go. Articulate that goal, and then that can inform the actual risk that you take. All right, so going back in time a little bit. So this is Hedy Green. So Hedy Green had the unfortunate nickname of the Witch of Wall Street. And so that is her. Not the most flattering picture, but this was a while ago. So basically, Hedy Green lived in the late 19th century, and she was one of the most powerful investors in the world, which at the time, and still, frankly, if you look at a lot of investment companies, was very rare for a woman. So she was way ahead of her time. So she had a $100 million fortune. So that's $2.3 billion in today's dollars. And she did this all by herself, investing in railroad stocks and bonds, government bonds, and mining stocks. And also provided a significant amount of loans to people and built a little bit of a real estate empire. So nobody really knew what to do with her. She was conducting business at a time where women didn't conduct business. She dressed very plainly, as you could potentially see here. She wore black. She was notoriously cheap. So Yeah, her frugality gave her this nickname, the world's greatest miser. And yeah, she was known as the Witch of Wall Street. So I guess that's what happens if you're ahead of your time and walk around, do business with men, and wear all black. So that is Hedy Green. So what do we learn about Hedy Green and her whole career? And we'll go into some examples. Is she went against the grain. So I think I've said this on a couple other times. You are never going to get different outcomes as an investor if you just do what everyone else does. And sometimes that's good enough, right? So sometimes that can be good enough. But also, if you were looking at what everyone else is doing now and just following everyone else into what I at least believe are a lot of very speculative places in the market right now, you're going to get the same outcome as everyone else. And I think what we learn long term, what is that outcome, is that people don't actually beat the market and do pretty poorly as investors. All right, so let's give some examples of Hedy Green. So one of the big trades she made is she invested in US dollars when they first came out. So I know everyone's exhausted by me talking about history, but after the Civil War, during the Civil War obviously lasted in the US a lot longer than people thought it would. It was a lot more expensive than they thought it would be. So the US government issued the first currency that was not backed by gold. They called them greenbacks, which people still call the US dollar. And so many people thought this was a very, very speculative investment. And basically they moved based on how the Union forces were doing in the war. And then as it's becoming more and more obvious that the Union was going to win, what people thought the long-term prospects were for the U.S. So after Lee surrendered, people looked at the country and thought, God, there's a lot of challenges. Lincoln was obviously assassinated, and people were very, very worried. And of course, these greenbacks plunged in value. And they got lower and lower to the fact where they actually got to 50 cents on the dollar. So that's 50 cents versus a gold-backed dollar. And what did Green do the whole time? She just bought and bought and bought and bought. And it eventually got to the part in 1875, so this is 10 years after the war ended, where the government basically folded all these greenbacks into regular US currency. So what they did is they backed them by gold. And all of a sudden, of course, they went up. So this was an example of where she did something that went against the grain and went against what everybody else thought, because she had courage in her convictions. She understood that she needed to stand her ground and be true to her own beliefs, and understood that, well, frankly, most of her investments were already caught up in the long-term success of the U.S., and that this was not any different. And she has these quotes on here, which are all very obvious, right? They're all very obvious. Everyone sits there and recites in investing, you buy low, you sell high. Most people don't do that. We have study after study after study that comes out that shows that people don't do that. So people that were buying Afterpay at $175 were not doing that. People that are buying Tesla now are not doing it. That is buying high. Even if it does go higher, that is simply not the principle of buying low. And obviously, I am making, I guess, I'm letting my own judgment about the future and some of these speculative investments come out. But at the very least, I think we can all argue that it is not buying low. Buying low in Tesla was when the company, no one thought it could stay in business, right? So buying low was when they didn't think they would ever be able to produce cars, because it was impossible for anyone to produce cars in a startup. That is buying low. So from a business standpoint, that's buying low and actually having faith in something going forward. Now, when everyone thinks that, well, Musk comes out there and says they're going to produce 20 million cars, it's a little different story. All right, and I think a good sort of analogy around this is sort of the reaction that people have when you are not a true believer in everything going on. And I think sort of the vehemence that people come out, and I wrote this series called Bubbleville, sort of looking at this, how a lot of my friends think I'm some sort of bear when most of my net worth is still invested in the market. And the reaction that I get and the reaction that people have if you have a different viewpoint is pretty strong. And the reason for that, at least in my opinion, is I think a lot of people know that's what's happening isn't sustainable, and they're just really looking for validation, and they don't want anyone to point that out. Yeah, it makes me, well, that's an aside we don't need to go into. No one wants to hear my view on children, right? Anyway, that's Hedy Green, the Witch of Wall Street. All right, another guy, Brent Shorer. So if anyone listens to Invest Like the Best, which is a really good podcast, not as good as Investing Compass, but a really good podcast by this guy, Patrick O'Shaughnessy, who's actually from the town that I am from in Connecticut. He's good friends with Brent. And he interviews him a lot. So Brent founded this company called Permanent Equity, which is a really interesting company. So basically what they are doing is they're taking a private equity model and applying it to small family-run businesses. And you know, he's an interesting guy. He basically got out of, I think he did a joint JD MBA, and got out of school and was really interested in investing and had been studying investing a lot. And he was trying to bring together these two different images or two different thoughts he had in his mind. So, you know, as an investor, what is he looking for? So he's looking for, and we talk about this a lot, he's looking for inefficient markets. So an inefficient market is where there can be large differences between value of something and the price. So we talk about inefficiency in markets when we're looking at where active managers outperform passive managers, for example. So that's what he's looking for. He wants to find places that have low competition, that they're fragmented, that there's less professionalism involved. He thinks those are good opportunities for investors, right? Why go out and compete with a bunch of people that are really, really smart if you can find a place where you're not? And then the other thing he was looking at is as an operator, as a business operator, he was thinking, okay, what do I want to do? Well, you know, at the end of the day, I want to look at very specialized parts of the market where people very much understand, potentially a very small part of the market. They really understand what they are doing. And he thinks that's a good, or a company really understands what they're doing. So he thinks that's a really good place to be, that there's not going to be a lot of competition going in there. Maybe you're doing something a little boring that isn't that exciting, and you're very specialized in it. People aren't going to go compete with you. So what he ended up doing is he started this basically private equity company that looked at companies that had earnings between $1 and $10 million that were family owned, and that he thought he had a real competitive advantage here because a lot of people weren't looking at these companies. They were too small for traditional venture capital to go into. And he thought, okay, well, this is a great opportunity. And so what he talks about here is boring. So boring businesses endure because they consistently solve a meaningful problem and were patiently built over decades. So investing, and I won't read the rest of the quote because you guys can all read it. Investing doesn't have to be exciting, and there's lots of quotes about investing that talk about boring. But boring is not a bad thing. And he says that all businesses have a shelf life, and that over time competitive advantages erode and economic cycles go up and down, and life happens. So it's the boring businesses that are going to be able to survive for a very, very long time. And he refers to something called the Lindy effect, which is a theory that asserts that some things, like ideas or books, actually get more durable over time. And sort of the example of the Lindy effect is that Plato will still be read in 1,000 years. The chances of Plato being read in 1,000 years are a lot higher than some book that just came out yesterday. And he thinks the same thing with companies. And I think you can apply this to public equity markets as well, that the longer a company has been around, more likely it is that they've obviously had experience weathering all these different storms, and the greater the likelihood that they'll continue operating into the future. So I think it's a really good lesson for us as investors, and I always talk about that Philip Morris example and everything they went through, instead of these new exciting companies with cutting edge technology. That boring is not a bad place to be as an investor. So I think he's taken the boring to an extreme, obviously by starting this firm, but boring investments are not bad. Investing is supposed to be a means to an end. It's not supposed to be exciting. I think everyone has a picture in their head, something around Wall Street where two different people, when you're yelling into two different phones, but that is not necessary. All right, let's see. Okay, the last one. Talk about Monish. So he started a hedge fund. He's written a couple books. The Danho Investor, the Low Risk Value Method to High Returns, which is a really good book if you guys are interested in that. And he says something kind of similar to what we heard by Brent before. And you can see here, invest in simple, well understood businesses and get acquainted with low risk, high uncertainty investing. Okay, so what does this mean? What is he calling for? Well, he is calling for investing in simple, well understood businesses. And the theory behind this is that if you invest in industries that have a really slow rate of change, that is going to actually make them a lot less risky. So let's talk about what he means by risky. I, of course, lost. So basically what he's looking at risk, he is looking at risk is losing capital permanently. So the risk is essentially a business going out of business at the end of the day. So as investors, he thinks we should look at capital loss as the main risk. And then we should embrace the fact that there's always going to be uncertainty. So the future is uncertain. We all learned that with COVID. Nobody would have predicted that before it happened. So the future is always uncertain. And Wall Street, of course, as we always hear, hates uncertainty. And it's uncertainty that is going to drive security prices to extremes because people are really worried about the unknown. But if they focus on very low risk companies where there isn't as much of a chance of permanent loss of capital, then that is an opportunity because it's the uncertainty which is going to cause that volatility, which gives you advantages as an investor. So, and he very much is a Buffett follower. So he was the guy that paid something like, I have it somewhere in here, $650,000 to have lunch with Buffett. So Buffett does this lunch thing where you pay a bunch of money and then it gets donated to charity. Well, he paid the most ever, I believe. Although, actually, I think someone paid $1 million a year. But anyway, nobody wants to pay money to have lunch with me, which is sad, but that is my life. So, all right, he says there are 7 questions when trying to evaluate a stock. And so you'll hear some of this Buffett stuff. Is it a business that I understand very well, and does it squarely fall within my circle of competence? So that is when he's talking about risk and low risk. Do you understand the company? Do you understand what the drivers are and how it's going to impact the company? A lot of people that are buying these tiny biotech companies and all these technology companies that don't actually understand what they're doing, that puts you at a lot of risk, right? When you're invested in something and you don't understand what's going to impact that company. The next question is, do I know the intrinsic value of the business today with a high degree of confidence, and how likely is it to change over the next few years? So that is also related, right? What are the things that are going to change? What are the drivers that are going to change the intrinsic value of a company? If it's Coca-Cola, there's probably a lot less than, once again, some biotech that's trying to invent a very specific drug for a very specific disease. He, of course, looks at margin of safety. Is the business priced at a large discount to its intrinsic value today? And what is that margin of safety you actually want to buy? Would I be willing to invest a large part of my net worth into this business? So one of the problem's probably the wrong word, but one of the things we confront with diversification is that, yes, if you're investing a tiny amount of your money, okay, people are laughing. If you're investing a tiny amount of your money into a certain business, hey, maybe you don't understand it. Maybe you're not willing to take a big enough bet. That doesn't mean put all your money into something, but it means think that way. Would you be willing to invest a lot more? As we said before, what is the downside? Is the downside minimal? So once again, let's think of a company like Coca-Cola. Is the downside going to be minimal there? Does the business have a moat? That's a sustainable competitive advantage, and is it run by able and honest management? I will say that basically going through this entire checklist is kind of what our analysts try to do. So if you think about the different ratings that they have, the uncertainty rating, which is what we basically equated to risk, business risk in front of the company, moat rating, we obviously create a valuation for it. So this is the process that our analysts are trying to go through when they're investing. So I think I need to look at comments because somebody's laughing. $1.26. All right. So Neil said that he'd go to lunch with me for $1.26. Do I have to buy lunch? And what do we do with the $1.26? All big questions. All right. Well, if anyone wants to bid more than $1.26, let me know. All right. Look at this. I created a summary. So I wanted to summarize the lessons, and then anyone who can get over Barangaroo can go out to lunch if you bring $1.26 to 26 by the anonymous attendee. Wow. We are getting up here. Okay, let's go through some lessons as we get more and more bids. Okay, so first couple lessons we learned: don't focus on data collection and noise. Instead, spend your time thinking about the simple attributes that make truly great businesses. And we heard a little bit about the end. Spend time thinking about what is the driver that makes this a successful or non-successful business. Patience. So we heard about patience and the ability to de-risk an investment just by having patience, right? That if you're not worried about where the stock's going to be in a year, and that you're worried more about 5 years, where the actual underlying business is going to be more of a driver than anything else, that patience can be a real investing edge for you. And remember, having patience is a huge investing edge over professionals, because most of them can't afford to have patience because they're being tracked on very short timelines, against their peers, against benchmarks, and there's a significant amount of career risk involved for them. So that's an advantage that you have as an individual investor. Next, we talked about goals. So define and articulate your goal, and that will allow you to figure out how to get where you want to be, taking on as little risk as possible. People that just say they want the most money are people that haven't actually spent time thinking about what their goal is and what would actually enable them to create the life they want. And start with that no risk option, then go up on the risk spectrum. Don't start on buying some stock that's trading at 1,000 times sales. Next, the only way to achieve a different investing outcome is to go against the grain. So this is from our mate, the Witch of Wall Street. And it's very difficult during times like today, market conditions like today, to actually stand your ground and be true to yourself and what you are confident in. But that's a lesson we learned from our friend Hedy. Embrace boring. So that's what somebody would do if they were going out to lunch with me. No matter how much money they bid, they would be embracing boring. But just remember that investing is a means to an end. This is not some competitive sport. There are no real points from an investing standpoint that you get for doing stuff exciting. All that allows you to do is go to the barbecue and have people impressed by you. Finally, our last lesson: the market hates uncertainty, but you don't have to. So uncertainty is always going to be the case in investing, but think about the underlying business. If you have a low risk investment, then there's going to be a bunch of uncertainty because none of us can predict the future, but combine the two, you can get high returns. All right. Look at that. We got through all our investors. Oh, look at that. Scott said that he would go to lunch with me, and he'll buy. You pick the place. And also, Scott says, Richer, Wiser, Happier is a great book on investors featuring Nick Sleep. A good recommendation for your audience. So I have not read that, but I will. So that's great. See, look, Shawnee, Scott wants to go out to lunch with me. Will and Shawnee are going out to lunch with me next Friday, and I created this whole plan. We hit a really big milestone for our podcast, and so I created this nice plan, I thought, and then they both shot it down. So now I have to spend my afternoon coming up with a new plan for lunch, probably something that does not involve me. All right, so we've got a couple questions. If you guys have any more, send them through. Uh-oh. Scott's in lockdown. Okay. Well, you know, I'm supposed to go to Victoria this weekend. I was supposed to go to Victoria 2 weekends ago. That was canceled. I'm getting ready to cancel this one. So I feel bad for you, Scott, but see, we could have gone to lunch this weekend. All right, Lisa. So Lisa says, Lisa, of course, of Alpaca fame, is saying, is layering risk on top of a risk-free base equivalent to diversification? Yeah, I mean, I think if you're talking about, Lisa, if you're talking about just looking at different asset classes, yeah, that's one way you de-risk your portfolio, right? Like instead of, and I think the example we're using, instead of somebody deciding that they need to be 100% in equities and that's their starting point, the starting point instead can be, okay, how do we start this with the risk-free and then take the risks that are appropriate and needed to get to our goals, which is your required rate of return. Okay, Lisa has another question. Lisa trying to win attendee of the day. Of course, Lisa has not outbid the $2.26 that we have on going to lunch with me. We'll have to find a charity to donate that to. Lisa says, do people not buy low because there's no media noise about cheaper stocks, so people do not know where to look for a good buy? Yeah, so I guess what I'd say is anything that you're going to get, of course, from the media is just going to reinforce the viewpoints of very cheap stocks. So whether the market as a whole is cheap, or individual stocks, yeah, I mean, you're not going to, you're just not going to hear that in the media, right? Because everything, of course, is the reason stocks are cheap is because people don't believe in their future prospects. So that's where you have to go against the grain. We saw this recently, and whether this is long-term or not, but we saw this recently with oil, right? So going into COVID, giant collapse in the price of oil. Recently, oil has done well as economies have started to open up, but that's just an example, right? There's nobody out there saying, hey, good idea to buy oil in oil stocks in June of last year, I would add, except for our analysts. Oil has recently done very well. Now, obviously, long term, we'll see what happens as we sort of switch to different fuels. But yeah, that's an example. Okay. Wow, Lisa went from $2.26 to $50. $50. No, she just aggressively went up. I like it, Lisa. That's good. That's good. To the charity of your choice, I'm going to have to look up alpaca charities. Alpacas that do not have nice wool and feel self-conscious about it, things like that. Okay, here's an easy question to answer. So where can I find last week's recorded webinar, please? If you just Google YouTube Morningstar Australia, they're all on there. So there's a playlist on there. Will probably put through he'll put a link in the comments. You can also always email me, mark.lamonica1@morningstar.com. If not, email Lisa and ask where we're going to lunch. Okay, so we've got a question. Okay, so we've got a question from Brendan. So Brendan is asking a good question because I probably did not explain it very well. Now I have to go through all my stupid notes. So Brendan's question is, he is asking about, can I expand on low risk but high uncertainty? Okay, so I think the big thing here is understanding exactly what he means by risk. I had highlighted a really good line in my notes, but of course I seem to have lost that. Anyway, so what he means by low risk is, once again, looking at that permanent loss. So he's describing risk as the potential for capital loss. So as an investor, what's the potential for capital loss? And uncertainty is just a range of possible outcomes. So I think what he's saying there is he's saying risk, when you're looking at risk, okay, as an investor, that means that you are actually going to lose your money. The wide range of possible outcomes is just the fact that the future is unknowable. and we don't know what this wide range of outcomes are. And he says when the market gets confused between risk and uncertainty, it's time to profit handsomely from that confusion. So, an example of that probably, if we go back last year, is, what was happening in that initial COVID sell-off, right? So we've got this disease. Nobody knew what it was going to do. Nobody knew what the impact was going to be, both from a health perspective and the impact on economies. So what happened? The market immediately sold off very, very significantly. And the problem, of course, or what you could do, of course, is that there was the opportunity during that sell-off to buy a bunch of companies that long range, there was not much of a risk of capital loss because they were companies that were strong enough to get through whatever these restrictions were. And then, of course, as the economy returned back to normal, continued to do well. So I think that's a good example. The market was freaking out because there was huge uncertainty. What's going to happen? Our economy is going to be shut down. What is the death toll going to be? All of which significantly exceeded anything that everyone thought, right? Like people think back and remember to that kind of first non-Chinese lockdown in Italy. They said it was going to be 2 weeks. And I think everyone just assumed all these things were going to be 2 weeks. Yeah, so I think that's the difference. So uncertainty is always going to be the wide range of possible outcomes to just life and anything in general. Then risk is just looking at capital loss. You think so? Okay, so good question from Paul, who bid $60 for lunch, and he'll pay. Wow. See, I just want to go to lunch with you two, and you guys will just say no. Yeah, I thought we could do, anyway. I was going to take them to a Korean barbecue place, and we were going to do karaoke afterwards. But Paul has a good question. So Paul says, as new to stock investor, what percentage would you suggest local to international shares, and how do the risk factors relate to international shares and ETFs? Do they rate as low risk? Okay, a lot of different questions in here. So let's get into some of them. So I guess the first thing I would do, literally the karaoke thing is on my screen. So I'm going to share Morningstar Premium, but just to give you an idea of what we recommend in terms of premium. This is where I was going to take them to karaoke, by the way. K1, they're supposed to have state-of-the-art equipment. They're not interested. Okay, so so Paul, let me show you a couple different areas we can go to. So I'll go into track investment. So this is Morningstar Premium and asset allocation models. So the percentage between international shares and domestic shares, of course, depends upon lots of different factors. But I'll go out to our aggressive portfolio. So this is a portfolio for people that have, I believe it's over, sorry, I'll go back just so I can get this right. Yeah, so 9-year time horizon. And so here's what we have on here. So 30% Aussie shares, 45% international equity. Then we also have 6% international listed property. And then there's a little bit of fixed interest in here, but this is 90% growth assets. So that is one of our model portfolios. You can sign up for a trial and look at these different portfolios in terms of global exposure. So then you were asking risk factors. So a couple different things. So obviously, the biggest risk factor that we face, that sort of in addition to just the risk factor of investing in equities when we go globally, is currency. So obviously currency fluctuations can have a big impact on your returns. So that's one thing I would think about. I've been getting all these, this is a little bit of an aside. There's been all these posts on some of these investing boards about buying US ETFs, which I always think is really interesting. So these are people signing up for accounts in Australia to buy US ETFs. And yeah, that's when you get lots of different weird currency things, right? You buy a US ETF that invests in Europe, and all of a sudden now we're trading euros for US dollars back to Australian dollars. So I don't really understand why people are very into this, but yeah, think about currency. That's going to be your biggest risk. You can, of course, hedge that currency exposure if you want. So there are hedged ETFs, hedged funds. It's different than a hedge fund. So you can look into that. And yeah, the ETF thing, I would say it depends, Paul. So an ETF, of course, is just a vehicle. It's not an asset class. So it depends what's in that ETF. So we did a podcast on thematic ETFs a couple times ago where I made fun of them for, close to a half hour. Half an hour rant, Shawnee says. So one of the ETFs we talked about is an ETF called FANG, right? One of the good things about ETFs is they generally in one trade, they allow you to diversify yourself. This FANG ETF is invested in 10 shares. So yeah, in that case, of course, you're not getting that diversification benefit. So it all depends upon what that ETF actually is. So at Morningstar, we don't really believe in those thematic ETFs for a number of reasons. Listen to the podcast if you like. I won't repeat all of my entire rant, but yeah, it depends upon the ETF. So look at that underlying index and look what's in that index. A lot of indexes are very concentrated. A lot of indexes, just because of the way the market has worked with the US and large cap growth stocks doing very well, are very concentrated in those sectors and in those countries. So just take a look what's in the underlying ETF. Okay, so really good question by Dennis that we do get a lot. And that Shawnee just had an email exchange the other week about this with our manager research team. So Dennis says, with ETFs, how do you know a good buy price to ensure a margin of safety? Your research doesn't suggest a price point. Exactly. Okay, so two different things. So we have a team of equity analysts that are rating the underlying shares, or the rating shares. And they, of course, are trying to calculate, they calculate and are trying to get right a fair value for every share that they cover. And then they're looking at margin safety to try to come up with a time where they think it's selling at a compelling value. ETFs and funds, when our manager research team is rating them, they are rating the managers and the fund company, not what's in the investments that are in the underlying investment, or not the investments that are in the ETF. I can't speak. And so what I would suggest is you can go in and look at valuation levels and look what's actually in an ETF. So let me share my screen again. This time it will not be on karaoke. I don't think. We can always go back. Of course, now I can't find my screen because I have 90 things open. This is why I don't do these on my computer. We got this special computer to do these webinars on. How have I actually lost this? There we go, we found it. I found it. All right, so if we go into, let's just pick an ETF. We can look up the ETF that I was just making fun of, because this will probably be amusing. Okay, so if you go onto any ETF, you can see that we do not actually rate this ETF. This is that FANG thing that I was making fun of. If you go into portfolio, and there's ways to do this if you don't have Morningstar Premium, which I'll explain in a second. If you go into portfolio, then it's actually going to look at what is in the ETF, and you can go in there and assess it. So we've got different value and growth measures on there. You can look at moat coverage that we have for them. You can look at certain sectors. So there are ways you can go in and look and try to evaluate the portfolio. Of course, look at the holdings. In this case, there are 10 holdings. So you can go in there and try to evaluate the ETF that way. The other way, of course, you can do that is just go to the ETF company's webpage and they'll show stats as well. Now, stats are probably going to be a little different just because obviously there are different calculation methodologies, but there are ways you can go in there and look at whether a certain ETF is undervalued or not. And we're going to release, hopefully in the next couple of weeks, a couple new features on Premium that should enable you to look at sectors and markets to see where we see opportunities. All right. So, All right, so a comment from John. Yeah, so John has a good question. Would you consider Australian travel stocks to have low risk with high uncertainty? Yeah, so what I would say with the Australian travel stocks, and there's been a lot of talk about them, so Flight Centre and Qantas, et cetera. Yeah, I mean, I think the important thing to consider is, and the important thing to consider as we're going into COVID is, were these companies financially strong enough to survive the disruption? There's obviously still a significant disruption to travel. Virgin, of course, is an example of a airline that was not financially strong enough to survive the COVID restrictions. Thing I would look at also in terms of low risk. Remember, low risk is around capital loss, and so one of the key inputs into that is valuation. So just be careful around valuation for those. It had been kind of a popular trade to go in and look at some of those travel companies. Okay, so Sally's got a comment, of course, for me. I was maybe too quick to judge. So she says U.S. Vanguard ETFs are really cheap and hugely diversified, so holding for long term seems better value than Australian Vanguard Index. Yeah, I will say there is more choice in the U.S. ETF market. So, for example, we're enabling them to go into part of premium, and yeah, I think we are going to add 2,600 ETFs. And so, in that case, there are certainly a lot more. Just be careful that a lot of, and there are certainly opportunities to invest in different indexes than you can get in Australia. Just be aware of sort of all that different cross-currency stuff you might be looking at. If you are investing, for example, in an ETF that's investing in a non-US dollar asset. So you're just going to go around a lot with currency, but that is a good point, Sally. Okay, so George has a question or comment. He says, is NAV, is the net asset value, a good valuation of an ETF? Okay, so the NAV is the price of, well, it's not the price of the ETF. The NAV is everything that's being held in the ETF at their current price, right? And there can be a small deviation between the net asset value of the ETF and the actual price. I think what we're talking about here, George, is that there can be opportunities, and we certainly believe at Morningstar, and I personally believe that there are times when there can be large deviations between the value of a share or a collection of shares and the price that they are trading at, so that the market can be overvalued and it can be undervalued. So that net asset value is just going to reflect what the market values something. So I think that is really where Dennis's question was around, okay, I want to look at valuation. Is this a good time to invest in this ETF in terms of sort of that difference between price and value? All right, we're out of time. Thank you for all your lunch bids. I ate alone today in the cafe, so clearly my dance card is open. But if anyone has any questions, just email me at mark.lamonica1@morningstar.com. You can also email suggestions of where I'm supposed to take Will and Shawnee next Friday, since they are acting like brats and don't like anything that I'm suggesting. But thank you guys. We'll be back on Thursday.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.